Hello and welcome, everybody. Thanks for joining me today. I'm your host, Ben Martinek, on the Catholic Money Mastermind podcast. Super excited about our conversation today. We try to get into more topical matters when we have what we call a round robin on the show, which is what we're doing today with my co-host, my co-guest, Anthony Guzman and Phil Francois. We're going to be recording and talking about investor expectations, how to set, what kind of expectations you should have when it comes to investing. It's general advice to invest and to be usually involved in the markets. And a lot of us have participation in the markets through employer retirement accounts, such as a 401k or 403b, maybe a 457b. There's a whole number of potential employer retirement accounts out there, not to mention, participation through individual IRAs and IRA, or even just having taxable brokerage accounts. So, there's plenty of opportunity in our marketplace to invest. But there is a bit of a question of what is it that we're doing when we're investing, and what kind of expectations should we have when we are doing that? So that's what we really would like to get into in today's call. But before we do so, Anthony, I was just hoping maybe you could introduce yourself back to the audience. You've been on the show before. It's great to have you back around. Can you tell us a little bit about where you're from and some of the work you're doing?
Yeah, of course. Name is Anthony Guzman. I'm a certified financial planner here in Austin, Texas, and have plenty of clients in Texas, but also across the nation. So happy to be here.
Awesome. And the company you're with is Pioneer Wealth Management. Is that right, Anthony?
That's correct. We're about 10 CFPs, and my focus has been more on the Catholic or Christian faith-based clients who want their values incorporated in their planning. So.
Awesome. Yeah, thanks for letting us know about that. And then for you, Phil, you're located, I think, in the Kansas area, but Kansas is a big state. What part of Kansas?
Yeah, I'm right in the central Kansas. And I'm the founder and owner of a company called Foundation Wealth Planning. We have our main focus is working with, primarily Catholic and other Christian families, typically more in the accumulation phase, have some business owners as well. And so I kind of work virtually across the state of Kansas and beyond with folks that kind of want to align their money and their values, but also making sure that they're making the most of kind of their income and kind of growing towards whatever that next step is, retirement or otherwise.
Awesome. Well, Anthony and Phil, thanks for being on the show today and sharing some of your insights and your thoughts. And, as we get things underway, when it comes to this question of investing, I kind of like to frame this when I'm working with my clients about letting them know that there's really just only so many ways that you can do something with your money on any account. Money's flexibility has kind of limited principles or purposes perhaps we could assign to it. And what I like to tell clients is, look, we can save our money, we can spend our money, we can invest our money, we could potentially give our money away, or we could opt, maybe if we find ourselves in a position where we don't need any more money, we could choose not to make it any longer. And by and large, I find that those are really the only 5 possibilities you could do with money. I'm kind of curious, Anthony and Phil, I've never really had anyone critique this. Do you guys agree? Do you think does that sum it all up in terms of the options available? Anthony, I'll leave it for you to kind of chime in. What are your thoughts?
No, that's definitely about it. I think I would just caveat, because I have a tax brain, as far as even if you choose not to earn it as earned income, you could still have, accounts that are working for you to where you don't choose necessarily to make more. That money is now working for you. That's our goal with our clients, at least.
Absolutely. Well, and then if that money is working for you, it's still working, and that means you're still making money. And so now there's some taxable ramifications that we got to be staying mindful of there, and potentially some good tax planning to go alongside our investment planning for sure. What do you think, Phil? Would you add anything add to the list here?
No, the only thing that really stands out to me would be, and it could kind of fall into either the spending or investing, would be gambling has become very big. And on this show, we would not promote gambling, of course. But some people think the stock market is gambling. But there's a distinction between the investments and that we're talking about versus, gambling at a casino or sports gambling or whatever. That would be kind of maybe its own subcategory within something there. Certainly not a way to really probably handle your money, but I think there's a distinction that we are going to talk about and how we're investing and not gambling.
No, I think that's a great distinction, actually, not one I've thought of before, because it's almost like recreational spending of one sort, gambling is, but then you do have professional gamblers who do make a living out of it. So it's kind of like it's like it is their earnings in one
Right.
nature. But then is it investing is kind of maybe, I think that's actually a perfect segue for us, Phil, because that's kind of the nature of the question is all investing, I think in some level, it implies a degree of risk that we're taking. And risk always has some degree of an implication of speculation, a gamble associated with it. If it's completely guaranteed, the risk presumably isn't, there's no risk there. And then, there's this whole relationship between risk and reward. And, if we're really not taking much risk, there's not a whole lot of reward. So like investing does imply that we're assuming some level of a gamble. It's a bet. But, I think that spectrum of betting, we can be really reckless with our bets. Speculative would maybe be the term we would want to use, or we could be more methodical and strategic. And I suppose I'd be inclined to say investing is the type of gambling in which, we're being methodical or strategic, analytical, rational, perhaps, in terms of what we're doing. And we're not just simply taking a roll of the dice, which is really what gambling so much is. I mean, I suppose you play the odds when it comes to gambling. I'd love to get your guys' feedback on this, but so much of gambling just strikes as, is it just sheer luck when you gamble, or what do you guys think when you hear of gambling?
The house always wins when you gamble, right? Over long periods of time. Now, maybe there are some professional gamblers that are good enough that over a long time they can make a little bit of money, but you're talking thin margins, right? Like barely over 50% over the long term, maybe adds up to some money. But in most cases, you're going to be under 50%, which puts you at a loss. And so if we're talking about investing, we're trying to allocate our resources to solid investments, rather be specifically in one company that we're allocating that dollars to that we think is going to produce a good and service that's going to provide value and grow over time. And that can also be applied more broadly to the markets in general as that theory. So we're taking that. You could say it's a bet, but it's an educated bet based on this company provides goods and services to the world, and then over time that becomes more valuable, and that's how our money grows. Versus the house setting up the rules that you're going to lose at least 51% of the time by the statistical odds, basically, or more. And I think there's kind of that distinction there with the odds of success.
Yeah, that makes me want to talk about negative and positive expected values. But before I nerd out with that, Anthony, I do. I'd like to get your feedback on this. I like what you had to say there, Phil. Or Anthony, would you concur?
Definitely. I think it's when we're doing investing well, the odds are more in our favor versus, the more speculative nature where we're just it's more randomized. It's not based on research. And I would say the odds are a lot more against you. So.
Yeah, I think that makes sense. Like, at least if someone is participating or running a gambling outfit, like they got to make money. And so, I mean, they want it to be profitable. And so what's the odds for it to be profitable for them versus profitable for you as the individual,
right,
participant or gambler? Like the odds probably aren't in your favor. And as an investor, if we broaden that out a little bit, it doesn't really make sense for you to invest in which we don't think the odds are in your favor. I mean, you could, but then I suppose what we're kind of saying by definition is that the more and more the odds are not in your favor, the more and more you're really just outright gambling. You're just taking a spin of the dice. And so like, let's speak to this whole notion of positive and expected value. And again, those are technical terms, and I don't want to go too deep into them, but they're worth noting is that we don't, when we take a chance on something, sometimes that chance has a positive value in which we think odds wise we will win, given enough iterations of the chance we're taking. Versus something that has negative expected value, we think that, given enough iterations, the odds are we're going to lose. And so, any investing should by definition have positive expected value. Otherwise, it doesn't make sense to pursue it. We're basically saying you're going to lose your money over the long term if you do this. So I think that's great, actually. It's kind of a foundational understanding that all investing is, yes, it's a participation, a risk, it's a gamble, but it's gambles that we think are going to pay off, and we think that odds are at least in our favor. They're better, more likely to pay off than they're not going to pay off. But maybe with that thought, so does that mean we just invest in anything or everything? I mean, look, the odds are in our favor, so let's just let her rip, right? We throw our money wherever. What do you guys think to that? Is that what we should do?
I'll start by chiming in that it's good to know what the investable world looks like. So what is available to invest? And I'm not that type of gambler. I rather think an analogy is I'm not going to be the one in the stands at a derby picking the best horse or the top winner. However, like if I instead bet on the entire race or just have a seat at the table or a piece of ownership of the whole derby, then I'm always winning. And then when there are losses, those are also kind of diversified out. So that's my approach is I don't have to choose the winners. I can be invested in a diversified manner that is just more calculated because I know that most of the time things will be up more than they're down. And so that's kind of our approach, which is a little bit more of like a more passive index-based philosophy that maybe some folks either can relate to or maybe have nuances or differences to. But that's how I think about it.
So I love that, Anthony, because it really brings a point is that, yes, you could try to pick, even in gambling, you can try to beat the specific what do they call it actually? What are the different blackjack? Thank you. Yeah, here we go. I don't always remember. Yeah. You can see how much I gamble.
Yeah.
So, you could take that, but maybe the better bet isn't actually trying to pick a gambler or be the gambler. It's just to be the house and, put your money with where we think this organization as a whole, regardless of the individual participants, the organization is going to win. And, we can have a similar approach in the markets. Like we don't necessarily need to know which individual companies are going to pan out or pay off or be the best winners. We just have to bet that the market as a whole is going to continue to grow. And, you can participate in that through, like a broad market index fund commonly. Phil, what do you think? I mean, is folks are looking to invest, even if something has positive expected value? I mean, does it make sense for you just to put your money in anything that has positive expected value? Or like what I'd like to maybe get out and get your thoughts on is like, look, even with positive expected value, there's a whole spectrum of risk across our investments. Yeah. And some things are just more risky than others.
A wide range.
What's your take on risk there?
Yeah. So risk is, there's a number of different ways you could define risk. Oftentimes when you're dealing with markets, risk can be determined, as volatility, right? Is how much, your accounts may go up and down in the short or long term. You could have certainly risk within a specific company going bankrupt or, risk that you can't get your money out. There are a number of different types of risk. So I think it depends on how we're defining risk, but ultimately, diversification is going to be the thing that kind of helps spread that out. So when we're thinking about, investing, a lot of times people think about the stock market investing. So when we boil that down, that's just trying to take an ownership stake in a company, right? So when we're trying to make that distinction from gambling, right? We like Costco, right? People pay their memberships, they buy a gazillion pounds of food, they make money, and then a portion of that money gets returned to our accounts and our accounts grow based on that. Now, Costco certainly could be a solid option to invest in, but would you put all your money there? There's a lot of risk. Sam's Club or whatever other new grocer could come in and swipe market share from that. So there's risk in having just money in just Costco, and if you like them and you get your food from them. So typically you'd have multiple different asset classes, large companies, small companies, and they all have varying different types of return profiles, right? So a smaller company is going to be more volatile, but you hope maybe has more upside potential. That's not always true. So there's certainly ways to kind of mitigate that and just kind of have it in different baskets, as we may talk about. And then there's also certain ways that you can invest in various debt instruments like government bonds and things like that that certainly have a lower return profile, but also a lower risk profile, right? So when you invest in government bonds, you're going to get a specific stated return, and that's going to be a lot less volatile. So they're going to be kind of on one end of the scale here versus some very high growth company. And you kind of have just a little bit of dots along the way, typically through broad-based funds. And then you can take the additional step if you want to kind of overlay, as we're talking here, any sort of moral screening on top of that. And that kind of adds another element of risk and return and things like that. So I think there's a lot of considerations, but just try not to be too focused on one area. It's going to help increase your odds of that positive expected return over time in various market conditions and kind of help your accounts grow over the long term.
Right. Yeah, Phil, I really appreciate that, because I think what you're alluding to, and Anthony even was touching upon previously, is this whole portfolio management concept that's evolved in recent years. Its name implies it's been around for a rather long time. It's actually a relatively recent development, but it's known as modern portfolio theory. came about in the 1950s and 60s. And it was really an academic, Harry Markowitz, I believe, who was like, well, what's, we recognize that there's risk and reward in the marketplace, but like, what's the way to optimize that risk and get as much reward out of risk as possible? Because we can take risk, but risk in its payoff isn't synonymous throughout. And some risk pays more than others, some risk pays less. And all things being equal, if I have two portfolios and they're both taking the same amount of risk, but one portfolio is expected to generate a higher return and another portfolio expected to generate a lower return, then we need to be, shifting to that portfolio that has the higher return. Like for as much risk as we're taking, in other words, we want to get as much return for that level of risk. And the reason why ultimately you would see a reduction in return is because fundamentally you're seeing a reduction in risk. And that's a fascinating concept, this notion that some risks compensate, other risks don't compensate. You can have compensated, you can uncompensated. And how we design and manage things, again, it's this whole notion of trying to extract all the return from the risk. But risk being what it is, I think this is the thing I'd like to share and get your feedback on, gentlemen, is that like risk does reward, but we call it risk and reward. It could just as well be risk and loss. Right? The other side of risk that's real. Again, we wouldn't invest if we were expecting loss. There needs to be a positive expected return associated with it. But it does have the possibility for loss, and depending on how you manage it, it may actually not just have the possibility for it. It may very well lead to losses. There are investment bets that you can make in which the outcome of that investment, especially if we're invested in let's call it an individual company, and maybe it's a young startup and it's a small cap company, that may turn to zero. You could put all your money into that and get nothing from it. And so, we have to recognize that yes, risk rewards, but it also loses. And, just because you've taken risk doesn't mean you're going to be rewarded for that risk. That's kind of the nature of risk is, it's not a particularly good mistress. Sometimes it rewards you. We hope it to reward you. That's the plan, but it may not either. I mean, it's not guaranteed. If it was guaranteed, it wouldn't really be much of a risk. So I'm kind of curious, Anthony, what are your thoughts on that? I mean, obviously, again, we're expecting positive expected returns. So we wouldn't do this if we weren't expecting the return, but portfolios don't always go the way we want them to go either. What's been some of your take in seeing, investments play themselves out in your career?
Definitely. It's interesting how much, I guess, a focus on orientation before jumping in. So if it's like right before we're jumping in the pool or we're going skydiving, and there's a lot of upfront education, but before we go out there, before we're deploying dollars, making that investment choice, we're going to talk about what all the risks are. And what I like to do is say, with any given investment, what is like historically the worst case scenario. So it's interesting that I'm a client wants to invest, they're excited and all of that, and then I'm telling them, all right, here's what the worst that we've ever seen happen. It's almost like you're not really selling me on this
Right.
concept. It's like, well, we've seen this in the past, and we go through the historical performance of all right, this is so far, and I present that question as, if this happens tomorrow, how do you feel or sit with this? Okay. And just what I'm noticing is, depending on where someone is in their circumstances, they're a young professional, single, high earner that has, 50 years plus of more accumulation, their response to that is a lot different versus, I have many, my entire family is, relying on this income. I'm going to not be working soon. Like, your level, your appetite is way different. And so I try to tell folks, all right, as long as we're okay with, all right, let's just say like US stock market, the worst it's ever been is a, 08 to 09 crisis. Let's imagine that this money that you're wanting to put to work, the worst it's ever done is lose about half of its value. How does that sit with you? And then I use their money. If we're talking about, $1,000, okay, it drops to 500. If we're talking about $1 million, not dropping to 500,000, that's a different feeling. So I'm giving their numbers and saying, how does that fit with you? Okay, now if it's not sitting with you, then maybe the risk profile is not right for you. And so and then also, what we're expecting on the other side, as far as, some type of average expectation that's positive, but I always start with, all right, let me tell you the worst case first.
Absolutely. So, I mean, a lot of what you're saying there, Anthony, is like, look, with good portfolio management, we're expecting positive returns here, but the journey between where we start today and where this might end isn't necessarily going to be a smooth one. And there may be years in which your accounts pull back, and maybe even from the get-go, we go and put this money in the markets, and then the markets, contract, and we can see an immediate, at least, loss as far as the account value is. It's worth noting that loss isn't loss, because you're still invested and those companies are still holding value. And depending on how you invest, especially if it's in a broad market approach, it's pretty difficult for that money to go all the way to zero, and especially stay there. I would put it as nearly impossible. But you as an investor, as a client, still need to be able to ride through this. And, it's just a current drop in account value. But if you then decide, no, I can't do this anymore, I need to get the money out of the markets. Like, now it's gone from just a drop in account value to a realized loss. Like, you really actually have maybe seen your money go away. And I love what you're doing there, Anthony, where it's like, well, let's just you have $1 million, let's say right now. What would it feel like to you if you wake up tomorrow and it's only 700,000? Like, is that something that you still be okay with? And we can keep pushing ahead? Or are you going to be like, oh my Lord, what have you done with all my money? You're losing it for me. I think it's good to walk through that and let the clients, say, yes, I'm okay with that or not, and then adjust accordingly. Phil, I'm kind of curious, do you have a similar process as you're working with clients to help to fine tune their portfolio to the amount of risk that they're willing to handle?
Yeah, mine would be similar there to Anthony. I think that's a really solid way that he described that, and I don't have a lot to add from that perspective. I think just when we zoom out, I think the bigger the additional thing would be to making sure that we're kind of aware of where we can jump off the wagon. I mean, I think when you look at average returns, right, and everybody tries to compare themselves to the average index return or whatever it is, I think keeping in mind that our portfolios probably are not just one particular index, right? There's some diversification there, as well as the average is something that only happens occasionally, right? So if the average market return, say, was 8 or 9% for a given index, well, most years it's not actually going to be that 8 or 9%. You're going to have a few years where it hits that range. Most of the time it's going to be above that, sometimes way above that, and often other times below that or way below that. And so it's a rocky journey, and we don't actually progress in the average that we might think it might grow, right? And there's years where we're down 10 or 20%, other years where we're up 20 or 30%. And then occasionally we get maybe that 7, 8, 9% return that's like, oh, we hit the average, but it's a lot of bumps along the way to get to that average.
Yeah, and it's almost, again, going back to the risk and reward relationship, Phil. I love that. I mean, if investing in the marketplace was as straightforward as investing in your bank account, and just like every year, if the bank account said, I'm going to give you 4% interest, and that's just what you get, and it reinvests on itself year after year, the market wouldn't deliver to you higher returns. It would deliver to you your bank account returns, because
right.
they're one of the same. Like, so why would you get compensated more for such a steady investment performance? The reality is if you want higher returns, you're going to have to pay for them. Like, you have to take more risk. And what a lot of times we mean by risk is that it's just a bumpier ride, and you're dealing more with uncertainty and the unknown and the possibility that this isn't going the right way. And so, kind of what I'd like to pivot to here is just how much there is an angle of faith in that we're taking. Like you kind of have to be able to have a vision ahead for yourself, and to know the course, and to maintain investor discipline, where the fact that maybe our accounts aren't in full alignment with where we want them to be, especially when it's not so much a problem when they're going gangbusters. Of course, that can be a problem too, but especially when things aren't going the way we want them to be able to maintain discipline, stay the course, and stick with your investment plan. And so, Anthony, some that you get floated around in our circles is this notion of like an investment policy statement, and ways to just, I love the fact that you're focusing on educating your clients. Do you guys like employ an investment policy statement, or do you have a way of like just helping to keep the client, on the course? Like, what's your guys' process for, keeping investor discipline?
Yeah, definitely. Kind of the follow-up document to those conversations is kind of the investment strategy, the investment policy statement, where we're both in agreement. I love the fact that it's this is what my recommendation is, and then also this is you signing off on this is our game plan. So when we do get out in the water and the storms come, or whatever it is, we're staying course. And that's been helpful to me, because if life changes 5 years down the road, we may adjust that, and that's fine. But there's always going to be uncertainty in life. And I think there's a lot of parallels between like the investment world and just like being on this earth, is that we don't know necessarily the future. We put our trust in the Lord in that. But if we have hope in that future, even if there's a period of uncertainty, and I can't think of a year where there wasn't something people were concerned about.
Absolutely.
And so there's plenty of reasons why not to, but there's also plenty of reasons why, like, that thing that you were really concerned about a year or two ago, isn't relevant anymore. Now we have other things to concern ourselves with. However, like, that doesn't necessarily prevent us from taking a leap forward. So I think investing is kind of it's hope that the Lord will take care of things, but then also that I am set up in these proper investment vehicles, which is why that investment policy statement is in place. But then it's also a bet that there's a better tomorrow, and that tomorrow doesn't have to literally be tomorrow, but just that long-term future hope is kind of what I would be betting towards. I wouldn't be a bear or someone who's negative about the future long-term view. Look at humanity. I look forward. I look to our children, next generations, and I'm looking forward to what more is in store. And so I don't have a issue with taking the next step, even if I don't know exactly where it lands us.
Absolutely. So, I mean, what we're really wanting to get into to set things up well for investing, Anthony, is like, look, we need good education. We need good risk tolerance matching, where we know what kind of risk we think you can handle and you can't handle in your finances. And that's not universal across everybody. But then we also need to recognize that, look, this isn't going to be a comfortable journey at all times, or at least if it is, you have a pretty conservative portfolio, and that has its own risk, which, Phil, we can talk about in a moment. So we need a way to kind of come to an agreement where, like, what are we going to do to help maintain your discipline to stick through and to some extent keep the faith? Like, this is really like one of the critical ways in which an advisor can be the deal breaker, maker or breaker in your situation, because perhaps you have your own concerns as the individual investor in what's taking place. But, hopefully as an advisor who's perhaps more well-read into these matters and has a higher degree of confidence, you can lean in and trust that and say, if their opinion is, hey, you just need to stay the course here, but you can get behind them and say, okay, if that's what you think we need to do, then I'm willing to trust your guidance and, let you guide me or lead me through, some turmoil that we've got going on. But so, I mean, a good investment arrangement is going to do all these things that we just made mention of. But Phil, one thing that does deserve attention is, like, look, we could try to keep everything super conservative and just like take almost no risk and just take whatever the risk-free rate would be, as we call that, which might be 3 or 4%, at least in the current market, but that could go lower. Probably not going to go much higher. Like, what's the problem if we just stay super conservative and not willing to take any chances? Would you have any concerns with that?
Yeah, I would have quite a bit of concern. I think certainly every situation is different, but in the context of the current market conditions that we live in, right? We don't live in medieval Europe or whatever the previous world was, right? In the way that the market is structured now, the money supply is growing, and there's different ways that manifests itself, but ultimately the cost of goods are rising over time, right? And that definition would be inflation, right? People have heard that number. The way the government calculates it is maybe different than how I would think about it, but ultimately the cost of goods over time are rising. And if you have this hard-earned money that we have, and we're just going to stick it in the bank account, it's going to be hard to stay a nest egg over time. And even if we can get right now, if you say a risk-free rate of return is say 3 or 4%, that might be similar to inflation currently, but over the last 10 or 20 years, that hasn't always been the case. So a lot of times you can get that risk-free rate of return, but it is lagging inflation. And even if the general inflation is that, there are certain parts of inflation that are higher, whether it be healthcare costs or whatever, that are exceeding these average rates. And it becomes very difficult where you think that, hey, this $500,000 or this $1 million portfolio that I built up, it wears away over time, right? At a 3% inflation rate. That means cost of everything is doubling roughly every 20 years. I mean, that becomes a really difficult thing to overcome if we're just sticking the money in the bank account and we're not growing the money or in any capacity taking on some risk for growth. So life involves risk. I think, we've kind of addressed that from multiple different angles today, but certainly being too conservative for your situation can be devastating, especially over long periods of time, whether that be for you, your family, or if you have charitable interests in trying to fund the church or whatever your long-term goals are, you can really be eroded away in that purchasing power over the long term. And you just got to be aware of that, because that can be devastating.
Yeah, absolutely. I mean, in economic terms, we call that opportunity cost. And I think that's probably best captured with, the slogan that we know of, a bird in the hand versus two in the bush. And so like we can settle on the bird in the hand, but if we never take the gamble and try to get two birds in the bush, like we're going to just always be getting that bird in the hand. And, as much as that might be comfortable and reassuring and, be an immediate short-term win, if we start to stretch this out over a long enough period of time, we may end up, losing out. That may actually be a riskier arrangement than had we just simply taken the risk and done more to improve the expected returns on the portfolio. So again, opportunity costs needs to be kept in mind. It's easy to kind of calculate and just see those returns, perhaps, let's say in a CD, and it's nice and they're comfortable, but there are other costs that are in play in that CD that you just may not be incorporating as part of your calculation that, if we're being honest, we really should be adding, what are you missing out on for having not done more? But thinking of this though, Anthony, so we've got perhaps, being overly conservative. We also have the possibility of just being overly aggressive and just shooting for the moon for everything, or trying to grow your portfolio to as big of a nest egg as possible. And let's just see what we can have, money. And on one hand, it's like, oh yeah, like who's not going to want money? A lot of people would find that a big reward. If you came home tomorrow and found out there was an extra $100,000 in your bank account, I don't think anyone is going to be like, oh man, that stinks. We find some level of happiness in wealth, in money. I think that's undeniable, but it's not as satisfying on the other hand as you might be. We could just be growing our investments really for no cause, no purpose. And so what's kind of interesting in my mind is just this connection of financial goals to our investments and tying those together. And Anthony, do you have some thoughts about just the importance of not just investing, but investing like with a purpose, with having some goal at the end of it all?
Yeah, definitely. I think that's why, whether we're in this risk conversation, it's not necessarily that we're coming up with one answer or one investment plan. We're kind of segmenting things based on when we expect those things to happen. So we talk a lot about what are our short-term goals, right? Like what's happening, how good of a condition is your car in at the moment? When's the last time you replaced your HVAC? Like those type of things that you're either expecting and also not expecting. What's happening in the next, 12 months, 18 months or so. The strategy for that money is going to be quite conservative. We shouldn't really be taking much of any risk in that money. And then we have kind of this medium-term goals where, maybe college is for your children is 5-10 years away or something, or a down payment on a home. Now we're in this like medium-term area where we don't want all of that just to sit in the bank and not do much. We want to do something with those goals, but we also don't have decades worth of compounding growth. And so that medium-term bucket, we kind of create a strategy for, figure out what counts are best for that. And then we think more long-term. I think of any type of, young professional that is worried about volatility in their 401k. I have to tell them, like, you can't tap into that money for another 30 years. Like, it doesn't matter what it's doing in the process. And so, but that's the aspect of what is a goal and what is the kind of time horizon and risk profile associated with it. So I try to break that up for folks. And so we split all that out to just provide a little bit more peace of mind. And it's not just a cookie cutter approach with all of your money.
Sure. So, I mean, the more of it's goal driven and we know that the specific purpose, I mean, that helps to drive the investment decision. Like if we don't really know what it is that you're wanting to accomplish with your money, and it's like, I don't know how to invest it either. And like, that's what I do for a living. Like I invest people's money, but like in the absence of your goals, there's any myriad of possibilities that you could do. And all of them could be good. All of them could be bad. Like, it's like, what are you wanting to accomplish with that? It starts to help us understand what it is that we need to do with the money. Phil, do you have anything that you'd like to add to that? Is that kind of the same experience that you've had with just the importance of goals driving the investment decisions?
Yeah. To me, when I talk with clients about it, it's, the goal is, kind of the destination. Really the investments that we're getting in with the minutia and everything, that's just the vehicle to get there. Right. And so you can take a different journey along the way. Different cars go different speeds. You could drive different speeds, but we're trying to get to the goal. And, driving faster has risks, driving slower has risk on the way, but we're trying to find a satisfactory route with the right vehicles to get us to those goals, both short-term and long-term. And so, yeah, I think everything you guys are saying is spot on, but I like to kind of have that analogy that, the way we're investing things it's just the vehicle, but ultimately having the focus on where we're trying to go and what we're doing today and along the way is really where we're trying to focus. And of course, just having that all oriented properly within the context of our life here and the next life and all that. So I think there's a lot of components to it, but yeah, the goals are going to drive the investments and how we're allocated for sure.
Yeah, one of the things that I've learned, I've been reading about in a book that I just want to make a plug for because it's been so informative, is this book called Happy Money. And it's the work of a social psychologist in which they're describing that, a lot of times people try to find happiness in money by just simply accumulating it. And they just think if their money grows, they'll be happier. And although there is some truth to that, the better use of money isn't necessarily just to grow it. It is perhaps just better ways to spend it. And sometimes we're forced with this decision of like, should I invest the money or should I spend it? And although, yes, investing the money in itself should lead to good things, at least minimally better wealth accumulation, like it could also be better for you to spend that money rather than to invest it in terms of the amount of happiness that it's going to give to you. Like I suppose I'm wanting to kind of round out our whole conversation with is we don't want to start attaching our happiness with our investments because like those in themselves aren't going to make you happy. It's actually at the end of the day, it's how you spend that money, even in the future, is what's going to make you happy. And, you can't know how to spend the money in the future if you don't know how to spend the money today. So to really do well with your investments is also have a healthy balance of what's okay to spend on yourself today so that you can continue to do that and not try to derive, again, happiness from your investments and their performance and their return, which I tell you right now, if you're trying to make yourself happy off of that, you're going to go crazy. So let me just throw that in there. Well, Anthony, you had some thoughts on, what are some conversation pieces that we could offer to people, talking points, just action items, folks, things that you could take back home with yourselves from this podcast and do for your own finances. And one of them, before we jump right into it, I would like to just suggest, folks, if you haven't, you could reach out to one of the Catholic financial advisors that we have within our network, the CFPN, and consider giving one of them a call, especially if you're like, I don't know what to do with my money and I'm looking for help. And this investment conversation, as interesting as it was, still feels well over me. Well, that's where you go and hire a professional. And so certainly look to the Catholic Financial Planners Network to help you out in that way. But for some of you who are like, you know what, feel really good, love this podcast, just tell me some things I ought to be doing or thinking about my investments. Anthony, what kind of guidance or direction would you offer to them?
Yeah, definitely just like, I would say take inventory of your current situation. Take a look, where are your accounts? Do you have them spread out in a bunch of places or just where are they and what's in it? And start asking the question like, how did I end up in this fund or account or whatever? And do I have a current investment strategy? Could I tell you why I'm invested in the things I'm invested in? Is it just because it was popular, because someone told me so? Just start asking the questions of how things are set up currently. And then I would maybe ask the questions like, how do you feel about that strategy? And has anything in your personal life changed at all that may warrant a change in that strategy? So, it's been 5 years, 10 years since you've taken a look, and now you're, closer to reaching that goal, or now you can't afford to take on as much risk, or, we have excess in whatever. Let's say we have too much in our checking and savings accounts, well above an emergency fund. Now I need to know what to do with it. It's worth revisiting that, and again, plugging in with someone that can help with that. And then I would add on top of those things, just being aware of what your tendency is around the concept of investing. I have a lot of folks who, depending on where in what decade they were born in, or what type of events happened, whether they were in a .com bubble and lost their job, or in a housing crisis, or if it's been the last 10 years that I've done, really well, even the last 15 years from a stock market perspective. Maybe you're a younger investor and you haven't experienced much loss, and you just think that this is the normal. All of those things, it's taking stock of what your tendency is around money. Are you, an avoider? Are you obsessively, interested in always signing in? This look at your accounts, factor out how you're contributing either positively or negatively into your own accounts. And if you need help, please reach out.
Awesome. I love those thoughts that you're sharing there, Anthony. A lot of this, we didn't talk about it much, but maybe it would be a good point to end on, is just this notion of an investment plan. Like, do you have a plan for your investments? Is there a philosophy? Is there a process associated with this? Are all your investment holdings in coinciding and working with that plan? Are we getting them all going in the same direction? Or is this haphazard and it's all over the map and you really just have no idea? You've just kind of thrown your money and you're hoping that it takes. So, taking stock, taking inventory, and really, if you don't have a plan, like determining, making a plan, I think it is crucial. Phil, do you have any final thoughts, for the audience?
I think everything that Anthony said was fantastic. I would maybe add into that, just taking a look on the front end, right? How much we're adding to those investment accounts, right? Maybe just taking stock as just zooming out a little bit from the cash flow part and kind of seeing how much we're spending, what we're saving and investing, and how much we're giving, and just making sure that we're still in alignment with our income and life stage, and that we're doing our, aligned towards those goals with how much we're saving and investing and getting in those accounts on the front end.
Yeah, Phil, I love that. That's a great suggestion for the end. It's like, as much as we centered in on investments, and that's what we wanted it to be about, we wanted it to be the expectations. What expectations should you have with investing? Look, if you only have $1,000 and it's perfectly managed, perfectly invested, it's just not going to matter. Doesn't mean a hill of beans, right?
Exactly right.
We need some saving going on here, and we need to be accumulating and adding to this next nest egg. And so, optimizing your investment portfolio when it's modest and small isn't really the critical thing you need to be doing. You need to be, increasing your savings to that portfolio, or if need be, increasing your income so you can increase your savings, or maybe on the other side of that, decreasing your expenses, but still so you can increase your savings. Like, that's the important piece to your investment portfolio, and that's circumstance, not tweaking your asset classes. So all this has a bit of where are you at in your life, and what do you need, and what's good advice for one person may not be the right advice for somebody else. Which again, maybe it's just a final plug. That's why you working with a financial advisor can make a lot of sense. So again, I hope you all check out the Catholic Financial Planners Network. Be sure to give Anthony and Phil in a particular way a look up. Check out their businesses. Anthony, if someone wants to reach out and find you, where can they go?
Anthony at pioneerwealth.com. You can find me on the Catholic Financial Planners Network, and you can also add me on LinkedIn.
Awesome. And for Phil, if someone wants to follow up and reach out to you, where can they go?
Yeah, you can check out the website, foundationwealthplanning.com. You can also email me at phil@foundationwealthplanning.com.
Awesome. Well, everyone, thanks so much for your time. It's a real treasure to have you here and be an audience. We continue to produce topics and shows that are hopefully of interest to you. If you have any ideas for maybe what you would like to hear more about, by all means, reach out to us, let us know. These round robins are an opportunity for us to share some more technical, topical matters, in addition to some of the background stories that we're giving to our advisors in the podcast. So please reach out and let us know what would be of interest to you. But between now and our next show, just want to wish you God's blessings to you. May God hold you all in the palm of his hand. Bye now. Thanks, Phil. Thanks, Anthony.